You watched your account drop 20% in 5 minutes, and you froze. You couldn't move your mouse. The stock you believed in, the one that was supposed to be the cornerstone of your portfolio, was in freefall. Then, a miracle. The selling stopped. The price found a floor, it bounced, and a wave of relief washed over you. You thought, the worst is over, this is the bottom. Acting on that relief, you bought more, eager to lower your average cost, to turn a losing position into a brilliant entry. And for a few days, it worked. The price drifted higher. But then it turned. It began to slide back down, slowly at first, then with more conviction. You watched in horror as it sliced through that previous low, gathering speed as if the floor had vanished. The hole in your account just became twice as deep. You didn't just buy a dip. You funded a capitulation. The emotional trap of calling a bottom snapped shut, and your capital was the bait. This painful experience is not random. It is not bad luck. It is a predictable part of a market process. Understanding this process is the first step toward moving from being the victim of it to being an observer who can profit from it. The market rarely, if ever, turns on a dime. A true sustainable bottom is not a single price point. It is a range, a zone, a period of testing and confirmation. What you experienced was the failure to wait for the market to prove itself. You mistook a pause in selling for the end of selling. The professional waits for confirmation. That confirmation has a name: the secondary test. It is one of the most reliable signals that the downward pressure has truly been exhausted. And its logic is rooted in the simple, unwavering law of supply and demand. To understand the secondary test, you must first understand the events that precede it. Imagine a crowd in a state of pure panic. A fire alarm has gone off, and everyone is rushing for a single exit. This is the character of a market in a steep decline. The news is terrible, the fear is palpable, and everyone who wants to sell is selling at any price they can get. This culminates in an event we call a selling climax. Picture a single day, or perhaps a few days, where the price drops precipitously on an enormous surge of volume. This is the moment of maximum pessimism. It is the sound of thousands of traders like yourself giving up, throwing in the towel, and liquidating their positions to stop the financial pain. But who is on the other side of those trades? Who is buying when everyone else is selling in a panic? The large operators. The institutional money. They see value where the crowd sees only fear. They have the capital to absorb this massive wave of selling, and they do so willingly. This absorption of shares on massive volume creates the initial bottom. It is the first sign that the trend might be changing, but it is only a sign, not a guarantee. Immediately following this climactic selling, something interesting happens. Because the sellers are temporarily exhausted, even a small amount of buying pressure can cause the price to rebound sharply. This is called the automatic rally. It's a technical reaction. Think of it like pressing down hard on a spring and then suddenly letting go. The spring doesn't just return to its normal state, it shoots upward with force. The market does the same. The intense selling pressure is released and the price bounces. Uninformed participants see this sharp rally and believe it's the start of a new bull market. They jump in, chasing the price higher, providing the very liquidity that the large operators might use to sell a small portion of the shares they just bought at the lows, testing the market's appetite. This rally is often swift, but it is built on a fragile foundation. It's a reaction to an oversold condition, not necessarily a reflection of new, sustainable demand. And this brings us to the most crucial phase of the bottoming process, the secondary test. After the automatic rally runs out of steam, the price will begin to drift back down toward the low point established during the selling climax. This is the moment that separates the amateur from the professional. The amateur who bought the initial bounce is now in a state of anxiety. They watch their small profit evaporate and turn into a loss. Fear begins to creep back in. The professional, however, is watching with calm, detached interest. This downward drift is exactly what they have been waiting for. They are not focused on the price, they are focused on the character of the decline. The market is now asking a critical question. Are there any sellers left? Is the panic truly over? When the price dropped to these levels before, it unleashed a torrent of selling. The secondary test is the market's way of going back to that same location to see if the same reaction occurs. The secret is not in the price level itself, but in the volume. As the price drifts back down to the area of the selling climax low, a professional trader is watching the volume signature with intense focus. If the price reapproaches that critical low point on significantly diminished volume, it is a powerful positive signal. It is the market shouting, "The supply is exhausted." The sellers who were going to panic have already panicked. The weak hands have already folded. There is no more fuel for the fire. The lack of selling pressure demonstrated by the low volume tells the astute observer that the path of least resistance is now shifting from down to up. Think of it as knocking on a door. The first time during the selling climax, the knock was met with a violent explosion from the other side. Now, on the secondary test, the market knocks again and there is only silence. This silence, this lack of supply, is the confirmation that a secure floor has likely been established. Let us construct this in our minds, a theater for the blind. First, picture a waterfall. Price is cascading downward relentlessly, bar after bar. Then at the bottom, imagine a huge splash. That splash is a massive bar on the chart with an enormous amount of volume. The water hits a solid rock bed. That is your selling climax. Following the splash, the water bounces high into the air, a powerful, chaotic spray. That is your automatic rally. Now the critical part. After that initial high bounce, the water doesn't keep flying into the sky. It falls back down. But it doesn't fall as a waterfall anymore. It comes down as a gentle mist, a slow, quiet drizzle. It lands back on the rock bed, not with a crash, but with a soft patter. That quiet, low-energy return to the bottom is the secondary test. The lack of force, the low volume, tells you that the downward momentum is gone. The market has tested the low and found it to be solid, defended not by frantic buying, but by the simple absence of sellers. It is this quiet confidence that provides the foundation for the next sustainable move up. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original, timeless wisdom presented in the annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. Understanding the theory is one thing, applying it is another. Let's build a clear mechanical algorithm for identifying and acting on a secondary test. This is not about feeling or intuition. It is about a disciplined, evidence-based approach. There are three distinct parts: the setup, the trigger, and the protection. First, the setup. You cannot have a secondary test without the events that precede it. Your checklist for the setup must be rigorously followed. 1. You must identify a potential selling climax. Look for a period of significant price decline that culminates in 1 or more days of extremely wide price ranges and a climactic increase in volume, often 2 to 3 times the average or more. This is the panic. 2. You must observe the subsequent automatic rally. This should be a sharp price bounce away from the climax low. It serves to define the upper and lower boundaries of what will likely become a new trading range. 3. You must wait patiently for the price to decline from the peak of the automatic rally and travel back toward the selling climax low. The character of this decline is paramount. It should be orderly, not chaotic. The price bars should be narrowing, and most importantly, the volume should be decreasing as the price falls. Weakness on the way down is a sign of strength. It shows sellers are not aggressive. Second, the trigger. This is the precise moment to consider entry. It is critical to understand that the trigger is not simply buying, because the price has reached the same level as the previous low. Buying at that point is still anticipation. It is a guess. The professional waits for confirmation. The trigger is the market's reaction away from the test level. You are watching for the price to approach the old low, do so on light volume, and then turn back up. A specific, actionable trigger could be the price trading above the high of the candle that made the low of the secondary test. For example, if the price drifts down, forms a small candle with very low volume, and then the next day the price moves above the high of that small candle, that is your signal. It's the market confirming that the test was successful and demand is beginning to overwhelm the feeble supply. This small sign of strength is your invitation to participate. You are no longer guessing a bottom. You are acting on evidence that a bottom has formed. Third, and most importantly, is the protection. Every single trade must have a predefined exit point in case you are wrong. Hope is not a strategy. For a long position taken after a secondary test, the protective stop-loss order is placed just below the absolute low of the test itself. The logic is irrefutable. Your entire reason for entering the trade is the thesis that the selling pressure has been exhausted at that specific price level. If the price violates that low and continues to move down, your thesis is proven incorrect. It's that simple. There is no room for emotion or debate. A break of the secondary test low invalidates the pattern. By placing your stop there, you quantify your risk. You know to the dollar the specific amount of money you are willing to lose on this one trade if your analysis is wrong. This is the cornerstone of professional risk management. It ensures that a single incorrect trade can never result in a catastrophic loss, preserving your capital to trade another day when a better opportunity presents itself. The market, however, is not a perfectly oiled machine. It is a complex, dynamic environment, and patterns do not always unfold as they do in textbooks. We must be prepared for variations and potential failures. Let's consider a few common scenarios. Scenario 1. The test fails. The price drifts back down toward the selling climax low, but as it approaches, something is wrong. Instead of volume drying up, it begins to increase. This is a significant red flag. It indicates that far from being exhausted, a fresh wave of supply is entering the market. Sellers are becoming more aggressive at these lower prices, not less. If the price then breaks below the prior low, especially on a spike in volume, the pattern is not a secondary test. It is a continuation of the downtrend. The attempt to form a bottom has failed. The correct action here is to stand aside. An astute trader might even see this as an opportunity to initiate a short position, using the failed test as their signal. This highlights the importance of volume analysis. It provides the context that turns price action into a meaningful story. Scenario 2. The market requires multiple tests. Sometimes the foundation is not set on the first try. The price may form a secondary test on low volume, bounce modestly, and then drift back down for a third or even a fourth test of the lows. This is not necessarily a bearish sign, as long as a critical rule is followed. Each subsequent test of the low should occur on progressively lower volume. Imagine tapping a wall to find a stud. You tap once, it sounds hollow. You tap again, a little further along, still hollow, but maybe a bit less so. You tap a third time, and you hear that solid, dull thud. That's the market finding its support. Each low-volume test further exhausts the remaining sellers and builds a stronger base of support. Patience is key here. One must wait for the definitive turn-up that signals the testing process is finally complete. Scenario 3. A sign of exceptional strength. In a very strong market, the secondary test may not even reach the prior low of the selling climax. The price will drift down after the automatic rally, but the buyers will step in before. The old low is reached, creating a higher low. This is an incredibly bullish sign. It shows that demand is so eager and impatient that buyers are not even willing to wait to see if the price will get cheaper. They are afraid of missing the move and are willing to pay up. A higher low on the secondary test, especially on low volume, indicates that the balance of power has decisively shifted to the buyers. This is often the precursor to a very strong and swift markup phase. It's the market's way of telegraphing that the period of consolidation will be short and the subsequent trend will likely be powerful. By now, you should see that identifying a market bottom is not an act of prophecy. It is an exercise in evidence collection. The selling climax is the first piece of evidence, the panic. The automatic rally is the second, the initial reaction. But the secondary test is the most important piece of all, the confirmation. It transforms a high-risk guess into a calculated low-risk entry. It is the market's own signal that the internal condition has changed. The crowd buys the first violent bounce out of fear of missing out. They are driven by emotion. The professional waits for the quiet test. They are driven by logic. They understand that the loudest moves are often deceptive, while the quietest moments can be the most informative. The absence of selling is a more powerful bullish signal than the presence of frantic buying. The core lesson from the secondary test is the profound value of patience and confirmation. In a world that encourages speed and constant action, the market rewards discipline and calculated inaction. The desire to be the hero who perfectly times the absolute bottom is a siren song that leads many accounts to their demise. The professional trader is not concerned with being first. They are concerned with being right. They let the market play its hand first. They let the uninformed participants fight it out, revealing their strength and weakness through the interplay of price and volume. Only when the evidence is clear, when the sellers have demonstrated their exhaustion through a low-volume test, does the professional commit capital. This single shift in perspective, from anticipating to confirming, can be the difference between a career of frustrating losses and one of consistent, methodical growth. It is the bridge from gambling to operating a business. You must learn to judge the market by its own actions, not by your hopes or fears. By learning to read this subtle language of supply and demand, you begin to align yourself with the powerful forces that truly move the market, rather than being caught on the wrong side of them. If you wish to continue decoding this language, to understand the deeper structures that govern market behavior, then continue this journey of education. The market is always speaking, and it pays to learn how to listen.